Let's see if I can follow that. Is audio okay for those in the back? Excellent. All right, we'll get underway. Thank you, Robert, for the introduction, and obviously thank you to the CFA Society of Atlanta for inviting me back to moderate the Masters of Private Credit 2.0. I can't tell you how excited we are to have the panel in front of you today, given that their firms collectively run more than $650 billion of the $1.7 trillion marketplace. It's pretty impressive. Now, the definition of private credit means different things to different investors. I hope you leave today with a better understanding of the key risks and opportunities within each subsector of private credit. Also, I will do my best over the next 45 minutes to bring up a number of topics that are shaping and changing the private credit landscape. We'll save 10 minutes for Q&A at the end, and we certainly do encourage your questions. So with that, we'll get to our first question, which may be the toughest of the day for our panel. In just a moment, I'll ask the panelists to expand on their answer. Colbert, you're going to kick us off, and that is, in one word, how would you describe the private credit opportunity in 2024?
Attractive. Attractive.
Joel?
I'll expand on that.
I'll go with idiosyncratic.
Jimmy?
I'll go with core.
Fair. Outstanding. All right, so let's expand on this a bit. There's a wide variety of flavors of private credit, and each of our four panelists have a slightly different background. So a lot of times private credit gets mixed up with just simply corporate loans, direct lending. There's way more to that, to the space than that. So Colbert, you want to talk a little bit about opportunistic and kind of some of the attractive nature of some of the loans that you're looking at today?
Yeah, thank you. Sorry, this mic is a little hot. So I wanted to frame up, as you correctly pointed out, Scott, there's a range of different ways that you can address private credit. And maybe to frame it up the simplest, and this is going to greatly oversimplify it, but if you think about the growth in private credit from about $100 billion asset class in 08 to $1.5 trillion or so now, you compare that to publicly traded debt, broadly syndicated debt, which grew from about $600 billion to about $1.6 trillion. You know, over a 15 or 16 year period, you've seen an asset class grow at almost 20% CAGR versus a comparable one growing at a 7% CAGR. Something is working right with private credit. Within that asset class, how do you disaggregate it? You know, there is what I think of, and I'm going to misuse this term, but I think it frames it up well. There's sort of more private credit beta. You know, it's much more of a market-driven product, financing sort of more regular way finance, LBOs, more sponsor-driven, that is really directly competitive with the CLO-led, broadly syndicated market. I would argue that in the private credit hands, that ends up with better documentation, better structure, and often better pricing, but it is more comparable than not to sort of the CLO world. Where many firms, and ours is no exception, started in private credit, I'll again misuse the term, but just to say sort of more private credit alpha, something a little bit more specialized, a little bit more unique, a higher spread product for taking on complexity that wouldn't work as well in a broadly syndicated market. You know, we always say if I can sit in a room like this and tell you the story under credit in 45 minutes and you get it and it would all be simple, we lose that deal every time to like a clean, easy execution, right? Where we like to find is something where there's a little bit more nuance, a little bit more complexity. So that more opportunistic, more specialty lending, you know, that's what we spend a lot of our time at HPS on, other people on the panel do as well. You know, that's one way to think about the differences between sort of more flow private credit and a little bit more specialized.
Joel, your background is a bit more asset-based. You want to talk about that opportunity?
Yeah, I'll go, whoa, that is not my, I'll go even broader. If you think about the corporate private credit market, that's, if you look at all private credit plus broadly syndicated fixed income, depending on which estimates you use, it's about $5 trillion. And if you look at the asset-based world, it's about $40 trillion. And the reason is that the asset-based side, when we talk about that, everything's a portfolio, everything's a loan, lease, or receivable, everything has contractual cash flows. And so the liquid side of that market is the asset-backed securitization market. So I always like to look at it as you touch our world every day, your house, your car, any lease you have, when you're streaming Netflix, when you're streaming music, that's all creating these contractual cash flows that go across that underlying world. And so the reason that market's so big is when you look at that across US and Europe, it's a much broader world. It's credit cards, it's autos, it's consumer loans, it's unsecured consumer loans. And so what we do from an investment standpoint is where direct lending is, and even specialty is really focused on EBITDA, and they're focused on single name corporate. Everything we do is a portfolio. Everything we do is asset focused. And a lot of it, I like to use the term asset-based credit. You're seeing some peers starting to use the term asset-based finance. And so we're the largest as it relates to asset-based credit on the illiquid side. There's some larger players on the insurance related with what Apollo's done with Athene, what KKR has done with Global Atlantic and others. We have that piece of our business now. We're sitting near $40 billion, but we've grown from about $5 billion in the last 5 years. And there's a reason for that, which we'll cover a little bit later, which is we're going through the same period of what occurred in direct lending in 2010, where those assets are getting pushed out of the banks. The difference is, if you look at a bank balance sheet just in the US alone, not even in Europe, that's $13 trillion of assets they own. I'm not saying that it's all going to go to the private credit market, but if even a fraction of that market goes to the private credit market, across all of those underlying assets, it's going to actually be an even bigger tailwind than what you've seen across the corporate direct lending in the last 10 to 15 years.
Over to you.
Less hot. But maybe I'll echo or build off of what Joel just said, and answer the question a different way. You know, private credit is often kind of talked about as like, you know, new or up and coming and something that's different, and how should we think about it in our portfolios. I think what you just heard here is like, it's not new. You know, this stuff has been going on for years, just really run and driven by the banking system. Right? After the GFC, the evolution of direct lending and private corporate lending really grew and evolved as kind of more of a standardized marketplace. And I think, you know, after the last you know, the turbulence of 2023 with Silicon Valley Bank and First Republic Signature, the next decade is going to be the evolution of overall private credit, right? And so if you think about when you say core fixed income, it's pretty broad range when the types of assets, the risk spectrum. Private debt is going to build off of that ecosystem, right? So we think about it as, you have corporate, you have real estate, you have infrastructure, you have ABF, and you have other forms of securitized assets. But in general, that pool is a secular trend coming off the banks, right? This is less cyclical and more the reality that regulators and policymakers have now looked at the reality of the imbalance of the asset liability match of deposit-based banks, ultimately asked them to get de-risked, right? Over the last couple of decades, you know, we've gone from 14,000 banks to basically 4,000 banks. On average, you see about 25 banks blow up a year in the United States, right? 08 and 2023 were obviously the large banks, but all of that risk ultimately falls on the taxpayer. And so, simplistically said, they're going to have to raise more equity. You know, Basel III is the big portion of that. But for the next 10 years, you're going to see evolution of all of this stuff, and private debt is going to go across that risk spectrum, right? All the way from what Corbin was talking about, more of that kind of venture, opportunistic, distressed, you know, preferred equity type strategies that are more of that equity replacement, through your kind of leverage finance plus type strategies, all the way to the investment grade portion of that, because all of those assets are for sale. US and Europe is based off of a regulation standpoint, and that's the newness part of that. Is for many of you in the room, these are all now far more available, or will be available, as strategies that can complement your overall portfolio or optimize the portfolio. So this is the next 10 years is going to be a pretty big evolution of the overall market across the risk spectrum.
Peter, I think your answer was fair, so let's see where you go from
Well,
there.
Well, what I mean by that is that I think now that borrowers and lenders in direct lending, we started out in a European context. ICG started in 1989, so we've been doing private credit of one flavor or another for nigh on 35 years. And we started Intermediate Capital Group. I guess what that was, Intermediate Capital Mezz. That remains a core part of the business. The bit I help look after is senior debt. We have then all of the flavors in between, be it term loan B, real estate, opportunistic, distress, blah, blah, blah. In terms of fair, I think what I mean by that, you've got Lazary coming, right? So I used to work for him, and we started a direct lending business at Avenue, and he in his usual hubris, would always be telling LPs, look, we're getting massively overpaid for the risk. And it was probably fair when we started out in direct lending in the European context in 2011, 2012, the returns were fantastic. And you've then had pockets of that. In 2023, I think somebody started at the beginning of 23, it was either Blackstone or it might have been Blair at Ares, said it's the golden era of private credit. And it lasted probably 18 months, really, because we were getting paid 600, 650 over for very good corporate loans backed by very good private equity sponsors, people that you will have heard of, doing good deals in good businesses that generated cash flow. That's ground all the way in now, maybe to 500 to 550, but it's a 10% return on a cash basis in the bit, the senior secured credit bit that I do. I think that's relatively fair in the current context. That's what I was trying to say, that we were at times getting overpaid for the risk. I think where it's ground to now, much as my colleagues, have to drag some of them, it's not January 23 anymore. It's okay to do this loan at 500 that we used to do at 600, just get over it. So that's the point I'm trying to make, that it's fair. How long have I got?
Please keep going.
On the unfair side, because there's two sides to every coin, I think there's an element around now that we all need to be careful of as lenders, and some of the things that we're letting private equity get away with in and around documentation, there ought to be a law. So we need to be careful that we don't get carried away, because it is an asset class that's been growing tremendously well. Firms that have made it this far are doing well, let's be clear. But we ought not to believe our own hubris and just keep sticking to the basics. Some of the things that we're being asked to do, I think, are unfair. For those of you that are into the detail on things like Crew, Chewy, Envision, Certa, things like that, where frankly you are not getting paid. It is not fair for the risk that you're being asked to take.
Let's dive a bit deeper into each of the segments. If you look at the market growth estimates for private credit, there's a $3.5 trillion number out there for year-end 28, which I think you're going to hear in a moment that we probably exceed that for a variety of reasons. And it's not just the change with the banks. I think there's also a change in how LPs allocated to the space. And so the question, Colbert, we'll go back to you. What do you think about this $3.5 trillion estimate, and how do you think the change in LP behavior is helping fuel that?
Yeah, I wouldn't get hung up on a number. And listen, I threw out a $1.5 trillion number for the size of private credit because that's like the convention that everybody quotes, and it's actually a real apples to oranges number with the broadly syndicated world, because that's committed capital plus invested capital. So don't get hung up with the numbers. Why will it grow? I think is probably the easiest way to answer that question. And I would argue it's growing for the same reasons that it has been growing for the last 15 years. If you think about it as in the broadly syndicated universe, we've seen steady degradation of publicly traded debt documentation. Peter just mentioned this relative to some of the worst abuses that happen in the public markets, people stripping out intellectual property, dividending out entities that benefited the equity. If you need evidence for what I just said being true, if you look at broadly syndicated recoveries, when broadly syndicated loans default, for a very long time they were between 60 and 70 cents on the dollar on average. For a very long time, Moody's always had 80 in their recovery math, which is its own question that you should bring up with your favorite rating agency friend. But if you look at the defaulted debt, if a broadly syndicated loan filed for bankruptcy in calendar year 2023, the average recovery last year was 25 cents on the dollar. Let me just say that one more time. 25 cents on the dollar average recovery for a defaulted broadly syndicated loan in calendar year 2023. And that's an apocalyptic number. Now, before one of my colleagues on the panel corrects me, I will hasten to say, of course, there's some selection bias in that number. If you were the first wave of filers in the cycle like this, you're probably a worse business. But the evidence of the weakness and degradation in docs is by the time you actually got there, because certainly you have no covenant, what's actually left. And it turns out the sponsor or borrower stripped the store shelves to your benefit. So why is private credit growing? Because private credit has better documentation and therefore better recoveries. I always think we get asked often by limited partners, what's the default rate? And I could walk you through chapter and verse default rates in broadly syndicated loans versus private credit. But I almost think it's the wrong framing. I actually think loss given default is actually what you really should be focused on as an investor. And the reality is loss given default is incredibly severe in broadly syndicated worlds, and it's tolerable in private credit. And so if you match all of that together on a risk-adjusted return basis with this trade-off of some illiquidity, the promise of the public world is that if something goes wrong, you can sell it. Maybe, but that's the argument. And maybe you sell it fast enough, maybe you don't. But for the trade-off for some relative liquidity to have the superior upside return as well as better downside protection, to me, that's why the asset class grows.
And Joel, you hinted at some much larger numbers. Is there anything you want to expand on that?
Well, it goes to how you define private credit. Again, I think it's, if you go back, I've been doing this for 27 years. If you go back to the late 90s, early 2000s, all capital that was raised in the private credit space was actually raised in the hedge fund space. And if you get to 2006, it was actually raised between hedge fund, the hedge fund side of the house, as well as was raised in the closed-ended fund, private equity fund. I think everybody agrees that the direct lending is a very large institutional asset class at this point. And now most pension funds or others will have somewhere between a 6 to a 10% allocation to private credit. Within that though, if you think about like asset-based credit and that piece of it, it's not, but it's becoming very quickly an allocation. And I think that it's at least gonna be a 1 or 2% allocation. And I think that will continue to grow. I'll go broader on why private credit's gonna grow though, which is, what are your alternatives? If you look at the last couple markets, the golden market of private credit is really simple. The arb is broken. I'm a very simple person. There's an asset yield and then there's a liability yield. The asset yield has to be higher than the liability yield. Otherwise it doesn't work. So if you're looking at private equity, if you're looking at private debt, real estate, if you're looking at private infrastructure, and you're looking at the equity side of the equation, then the arb is broken. With rates having gone up, if you strip things back to their asset yield, most of them are yielding less than what you're seeing on the liability. So the answer is really simple. Everybody likes to talk about it and make it complex. When the arb is broken, you don't want to be in the equity. You want to be in the debt. So of course you want to be in credit. And in this environment, in a higher rate environment, you have no choice but to be in credit. Because anything else you're doing is making a time bet or a theta bet, and you're gonna get destroyed by it if you're wrong, as we've seen with the constant changes on the Fed and other pieces. So when you look at the universe and you say, okay, what are my alternatives? I get to invest in public equities, where if you look at there's a great study that was put out this last week, where it talked about what the 5-year projected return should be when we're at this valuation on a PE multiple on public equities. Congratulations, for the next 5 years, you should expect a 6% return. That's public equities for the next 5 years, 6%. So when you're at this kind of valuation, this kind of earnings growth, you're expecting 6%, which is barely above where rates are. If you're looking at private equity, as much as people love to write bad articles about direct lending and private credit, there's a person who owns the other half. If you go back through the history of finance and you really go through private equity, the thing that gets missed, and I'm a big history geek, so I love this stuff, the thing that really gets missed is if you go back to the 90s, the equity check was 5 to 10 cents. If you go to the early 2000s, the equity check was 20 to 30 cents. If you go to post-GFC, it's 40 to 60%. So if you really actually have any concerns on the credit, you should be scared crapless about the equity, because 40 to 60% of the check is that. It's why private credit is so attractive in so many ways. We see the same thing in asset-based credit. Asset-based credit is a covenant-heavy world because the liquid side of our world is covenant-heavy. I fully agree with your analogy. I'm going to throw in, I'm going to talk to your world a little bit. I'm going to throw in one other analogy. I would argue we're already in a default cycle. I think we're already in a default cycle when we look at near prime and subprime consumers. We've seen it in the numbers, we've seen it for a while. We talked about it in our newsletter at the Gaps 2 years ago. Now you can read a lot of articles that agree that we're in a default cycle with near prime and subprime consumers. I think everybody agrees we're in a real estate default cycle, at least office default cycle in a way that's just as bad as subprime are, yes. I think in corporates you're seeing it in healthcare from a segment standpoint. But if you look at even the broadly syndicated side, because I agree, what's your alternative? You can go to the liquid markets where you can go to the default rates you're saying, or you can go to recoveries you're talking about at 25%. And to be clear, that whole selection bias, it never went below 55, ever. So 25 is a very bad number on an annual basis. And so when you look at that selection bias, you look at that piece, the other number I throw out there is the default rate right now is 1.6, unless you include distressed exchanges, and it's 4.1. I think most people would say we're at the default cycle. So I would say that the old default rates are actually meaningless when you talk about default rates, when you talk about the broadly syndicated market or the fixed income space, because the old default rates are based on bankruptcies and payment defaults. The new defaults are distressed exchanges, because the old defaults were retail, they were manufacturing. They're assets you had to go through a bankruptcy to clean it up. If you talk about software companies, if you talk about a lot of healthcare, you talk about a lot of services related companies, you actually are an idiot if you go into the bankruptcy, because there's no reason. All you need to do is clean up the cap stack. So you're going to see the new default rate should not be the default rate. The new default rate should be exchange plus that piece. So this is the reason I said idiosyncratic. I think there's great opportunities out there, and I think that private credit will continue to grow, but I would argue and challenge anybody to say, what else are you going to invest in the next several years? Venture? I would love to see how you determine the beat. Public equity, 6%. Private equity, everything else is a timing bet, and everything else, when you look at the compression of you're making 10 to 15% in private credit, I don't think there's another asset class where anybody can really pound the table and think you're making more than 15 in the equity. And you're gonna have to be right on cap rate compression. You're gonna have to be right with regards to timing in order to even make a 15. So that's the reason I think it grows.
So it's not uncommon for lenders to talk about the downside. We're going to talk about risk and systemic risk in just a second, and also distress. You got a flavor from Joel there just in the last few moments. Jimmy, anything to add in terms of this $3.5 trillion target? Maybe some different opportunities. I know some synthetic risk transfers are very for you of interest.
Yeah, and I agree with Corbett. It's the number of $3.5 trillion. You know, people have thrown it out there by making some estimates and assumptions, including ourselves. I think it's a very modest number to think about, right? Joel just mentioned the size of the banking system, right? At the end of the day, this is a forced selling, right? The banks have to deleverage, they have to over-equitize themselves. And so that shift, and we see it as over 20 trillion in the US, it's 29 trillion in Europe. Like, at the end of the day, trillions have to come out of the banks. Some will go public, some are gonna go private. And it's not just corporate lending, right? It's not the growth of that, but it's the expansion of the overall private debt universe. It just has to happen because of the regulatory environment. And so that's the growth side. And my colleagues just started talking a lot about the demand side. It is a really good fit from a portfolio standpoint, from a yield enhancement, from a diversifier. You know, we all know that in the last 2 decades, as the private markets, public equities and credit have all grown, we finance different industries, we finance different companies, even from a diversifier to get access to some of those industries that have more growth tilt to them. Like, you want to be in the private market. And then as you build your portfolio, I mean, we talk about illiquidity. Like, yes, it's illiquid and some of these structures are illiquid, but as you go down sub-investment grade, you're talking about 2.5 to 3.5 average life for a deal, right? So your ability, as you think about the next couple of years, to earn a double-digit type return and be able to get your principal and income back and be able to make different decisions in 26, 27, 28 to optimize your portfolio. Because let's just say in 2 years there is, you know, equities are back down to 16 times and you want to change your portfolio construction, right? This is like, it's illiquid because you can't necessarily just take a loan and trade it like you can in the BSL market. But you think about how do you utilize it in your portfolio or your aggregate portfolio, there's a lot of flexibility when you think about how you're going to tilt that portfolio over time. And again, inverted yield curve, spreads where they are, this is a marketplace that has a lot of relative value. That relative value is different than what it looked like 3 years ago. Not just because of what you talked about, but like in a zero rate environment, in fixed income, you wanted to avoid duration. So going floating rate product actually made a ton of sense. So I don't think $3.5 trillion is a big number when you think about the context of what can get included in what is your private portfolio, defined as anything that is bilateral negotiations between your kind of borrower and lenders to create a better kind of risk-reward profile. So you get down to that downside risk. At the end of the day, I joke around liquidity and downside, and I agree with the loss given default, but I used to joke around like 5 years ago, 10 years ago, Apple dropped like 40% in a matter of like a month. And it was just like, everyone was like, well, that was liquid. But if a loan goes down 10 points, like it's on CNBC every day, that there's no liquidity in the market and it's broken, right? At the end of the day, the speed to transact is different than the cost to transact, right? So when you think about like the downside protection, part of that is we're underwriting loans or assets that we know we are going to hold them through the life of that, whether we're going to take it out from a refi or ultimately have to work through a restructuring or rebalance associated. So very, very heavily covenanted to protect us against that, which is why in many cases the volatility or the recovery rates may have an inverse relationship with regards to the equity beta or earnings beta in the market, because even though we might be exposed to the downside earnings, the value of those covenants go up dramatically, and as Joel talked about, if there's somebody else owns that 50%, if it's not working out, we start to eat into the value of that 50% in order to get our claim back, right? So then you see that, like, so the vol is much less from a loss assumption. The volatility from a price standpoint tends to be driven because we deal with more secured floating rate and covenants. So as Corbett didn't talk about, but the old broadly syndicated loan market was called the par loan market, right? Because everything traded between 99 to 101 because it had covenants. And then after the GFC, more unlevered buyers outside of CLOs came in, and they got rid of covenants because there was more, they didn't necessarily care about that because they weren't a 10 times levered vehicle. The private market still is, there's variance of covenants based off of time, but there's still a heavy focus on what are your protections for that downside. And so that floating rate that secured those covenants allowed for that. And I think 2022 was the best example where inside of BlackRock, and we have every asset class, everyone was debating that this was a bubble and a risk, there was more money pouring into it, and I had to stand up and remind everybody that in the prior 12 months, equities were down 20+%, investment grade was down 20%, and investment grade banks, several of them went under, right? So like when you think about, again, the risk and the characteristics of risk and how it acts in different environments, both from a vol perspective, but from a net return perspective, like that's where you start to get that attraction. And even if you had a default environment, and I agree, like the default environment today is very different, everything that Joel talked about, but policy has changed in a way, transparency has changed in a way, and industries have changed in a way that you don't necessarily have the same boom-bust environment where you go 0% defaults for 4 years and then you have a liquidity shock and you go spike up to 12, 13%, right? Those we used to call like free fall bankruptcies. Now it's far more, I would call it, projected out, and certainly in the private side you have more transparency as they breach covenants to try to work with those borrowers associated to that. So a 5% default cycle is probably something more of the norm, where you're going to lift between 3 to 5% because businesses become obsolete, management teams make mistakes, they get too aggressive with their balance sheet. Those things generally happen. But if you look at that, just take that for a second, 5%, and let's just say you had a 70% recovery, which is better than what you see in the public side, and you can debate that. Like, I think loss given defaults have been much better than that. You're talking about 150 basis points off the top of a 10 to 12% direct lending market. You're still getting high single digits, which is still very competitive at 6%.
And Peter, from a European perspective, what would you add to that?
Not that much to add. So from a European perspective, our banks are always slower than your banks to rip the sticking plaster off and let themselves bleed. They just take, I've been doing leverage finance now for 34 years, and the Italian banking sector is always about to go boom. And it hasn't and it doesn't. And if you're up against UniCredit on a deal, it's a disaster because they will protect their turf. So the banks are still pretty slow in the European context of getting on with it. The regulators are pushing them very hard. Ultimately, I believe that this asset class will still continue to grow at the clip that we have seen. From where you're sitting, if you're thinking about allocating and getting involved, I tell all our LPs, anybody who sits in my seat who's doing first lien senior secured loans to corporates, who tells you that they generate alpha, you should just leave, because we're not here to generate alpha. The credit manager, he or she who will do best for you over the next 10 years is he or she who loses the least amount of money. So it's back to, defaults are okay, but you've got to get your money back. And we'll have defaults, and that for us is always an excuse to put another 100 or 200 basis points on the rate, charge an extra fee, maybe you can, it's an opportunity if the business isn't completely broken to actually earn more return. And the best deals for us are those that sort of don't really do what they said they would do, and they bump along, and maybe they breach a covenant, and they stick around for 4 or 5 years. They're the great deals. They take work, but that's when you really make a lot of money. And forget about the IRR, because you can't spend that. It's money multiple you want to be focused on. And so those deals that look a bit rubbish from the outside, but really are some of the things we'll do best for all of your pensions. But in a nutshell, I still think there's plenty of growth to grow in Europe. The banks still need to delever. You're probably going to ask a question about regulation, so we'll get on to that. But ultimately, the sector still remains, from a private credit perspective, pretty disciplined, carries very little leverage, certainly compared to the banks, carry no leverage compared to the banks. These loans are not parsed up and resold and resold and resold, so you're not going to have a private credit CLO squared anytime soon, I don't think, certainly not in a European context. And so these are all very old school, line by line corporate loans with people who've been doing credit for a very long time.
There's 2 topics I want to hit that show up in the press a lot. So I'm going to read 2 quotes, because I want to make sure I get these exactly correct. You might be surprised, but not everyone is a fan of private credit for a variety of reasons. The first quote comes from UBS's chairman. If there's any UBS friends here, I apologize. But he warned back in November about the risk in private credit. And the quote is, this is at a conference in London, there is clearly an asset bubble going on in private credit. Which is interesting, because UBS wealth continues to allocate to private credit. There's no regulators in the room, I didn't say that. That's quote 1. Quote 2, I think, is equally interesting. And this is from some S&P comments from November, Bloomberg. Private credit hasn't really been tested through a credit cycle. There will be a lot of investors in private credit funds that will experience a loss of principal. So can we talk a minute about systemic risk that private credit, according to the press, may be introducing systemic risk into the markets? Or is it the other way? Is private credit taking systemic risk out? Over.
Yeah, I actually don't think those quotes are saying that there's systemic risk to private credit. I think they're saying there's risk to private credit. So on the first point, like, does private credit create a systemic risk? I would argue it helps solve one. We've talked a lot about the transfer of assets from banks to private hands. If we wake up tomorrow and HPS has failed as an institution, it's a really, really bad day for our investors. It's a really bad day for me personally, and nobody's going to blink in the world other than those sets of people. There's no counterparty risk. We don't run leverage the way banks do or a CLO does. There's no ripple effects. It's a really bad economic outcome for a small group of people, and that's it. And so I think from a systemic risk perspective, private credit, I think, solves a banking problem. It doesn't create systemic risk. Now, what that second quote says, which I think is actually totally fair, is private credit hasn't been through a cycle. And so we've talked a lot about private credit and tried to disaggregate various flavors of it, but we've treated it fairly monolithically as an asset class. And the reality is different kinds of firms that do business in different kinds of ways are going to perform better or worse. When the market, if Joel's right, we're already in a default cycle. I tend to agree with that. Like, we're going to go through a tougher time. And there's plenty of people who are doing this, who started their businesses, in a time when, everything was up and to the right. We've had 0 interest rates for 15 years, and what in the world could ever go wrong? I would always think, if you're thinking about allocation, understanding people's workout capabilities, workout experience, what's actually happened when something goes wrong, I got a call the other day from a headhunter who was asking for a reference check on a hire for a workout person to a large credit firm that I guarantee you would know by name. And I asked the person back to them, I said, well, what team, tell me about the person's team, because to answer the question, I needed to see how they fit into the organization. They said, no, it's their first workout person they're hiring. And I swear to you guys, my jaw almost hit the floor. Like, that is a stunning data point. And I would tell you that if you think seriously about private credit, the institutional scale really matters, the capabilities of a workout function and all of that. Because I agree, like whoever that second quote was, that's true. Like, it's not been through a cycle. You need to understand how people can react. And I would actually argue there's going to be more rather than less dispersion within private credit in terms of how people react when things get more complicated.
Yeah, I actually disagree on one part, which is I think we've already been through a credit cycle. I've been doing this for 27 years, and I will say the first few were at banks, so I'll take that one off to the side at the end of the 90s. But if you take away from that standpoint, you're talking about 2002, you're talking about GFC, you're talking about COVID, you can even throw in there if you want to, what happened with regards to the downgrade of the US and kind of that year we lost along the way. So I think the market has proven itself, and I would go to, I forgot who said it earlier, but I mean, there's no difference between what's going on in private credit and lending to corporates, what's been going on for 100 years. It's the same, it's just not doing it inside of banks versus inside banks. So that part worries me less. I'm gonna go a different way, which is this. We are here to partner with banks, not to compete with banks. Having said that, there's only one systematic risk, and it's banks. It's very simple. We talked about liquid credit earlier, which is, okay, so if you wanted to say why we've had systematic risk, it's liquid credit and banks, and I'll go through why. If you go through the end of the 90s, and you go through the Asia crisis, and you go through the ruble and the other portions of things, and you go through the bailout of the long-term capital management, it wasn't a bailout of a hedge fund, it was a bailout of the banks. The hedge fund got zero. The banks got bailed out because they had all the counterparty risk, because what they do, they over-lent like crazy to a whole bunch of liquid-related assets. One. Now let's go through to the bailouts and what occurred in the GFC. That was a bailout of banks. If you go through what's happened with regards to COVID and the agencies, that was a bailout of banks because the plumbing was done. On the most liquid asset, because the asset class that was broken was agency mortgages. No risk of loss, just basically processing because they over-lent to the counterparties in that piece of it. So when you really think of LDI, when you think of all of these things that have occurred, it's a bailout of the bank side of things. Why? Because if you go through 10,000 years of history, banks were the only thing that actually was the air in the balloon that was inflating and deflating cycles. Credit is the air, and banks were the one that did it. So if you wanted a money multiplier, you had to have banks. That changed in 1970. We started to have the securitization market. You look at it today, it's not one pillar, it's five. You got banks, you got insurance, you got ABS market, you've got the pensions and the sovereign wealth that act in their own pillar in my mind, and then you've got private credit. We all partner together. We all compete in some ways, but there's five pillars. Now let's go back in reverse on those pillars. Private credit, to what you stated, matched funding. The fund life matches it, you're not using a lot of underlying leverage, most of the funds have no leverage. Sovereign wealth and pensions, matched funding. Insurance, matched funding, outside of some cat and some life, but generally matched funding. So if you think about these different areas and you go through those areas, there's only one that's always unmatched funding. JP Morgan will fail tomorrow if we all ask for deposits. It's a 10-to-1 levered product. The top decile, largest tier 1 ratio was Silicon Valley Bank. And they failed because they owned agency mortgages. Because they held long-term fixed rate assets, mainly Ginnie Mae's and Feddies, and they ended up having a run on the bank, and they had huge mark-to-market losses, and they were a forced seller of those assets. So by definition, there's a reason that de-bankification has to occur, because banks have short-term floating rate liabilities. You could argue it's a day on how short-term their liabilities are. So they can't do long-term fixed rate assets. And so there's a reason the government has always had to prop up banks, and that's because they were the money multiplier. When you look at the four pillars that now remain as that goes, you don't actually need them as much. So the systematic risk is within banks, And the greatest thing you can do is diversify across that. So regulators, of course, want banks to be boring. They want banks to be boring and want them to continue to be boring. And that's the transition we've been going through since GFC, and we're going to continue to go through for this. And that's just the facts. That's just the reality of this nature. And so that transition of those assets, just like what happened in corporate direct lending, they still own the risk. They still lend to some of those funds that are 0.5 to 1 or 1 to 1 leverage versus the 10 to 15 one they run. They still own CLO AAAs. Isn't that better? So that's the thing that's happening that's a broader basis, and that's why this market will continue to grow, and that's where the systematic risk is. The liquidity premium, it should be, you talked illiquidity premium. It should be a liquid premium. The asset classes that are always the most over-levered and always cause a systematic risk are not illiquid assets. It's always the liquid assets, because that's the ATM. That's where you go, that's where you grab it, and that's frankly the area that always gets the most over-levered.
That's quite sobering. Jimmy, you want to add to the systemic discussion?
Not much to add. I mean, largely covered it. The one thing I would sit there and say, and I think we'd all agree with this, and the comments made here, we think it is complementary and obviously not adding systemic risk. But we do think that as you become, or private investors become a bigger part of the market, there are parts of the market that should have some more oversight, like the mutual fund space, right? Daily liquidity mutual funds should not all of a sudden grow into owning 15, 20, 30% in private assets, right? That's going to create a risk. We saw the UK LDI crisis last year because people were overextended when it comes down to their commitments relative to the underlying assets, so there was a mismatch in liquidity. Those were all the banks lent. But my point being is, like, the capital markets ecosystem is evolving, and regulation and policy should evolve with it. The simplicity of the private credit lender and the match funding is not something that ultimately it's reducing the systemic risk because of that imbalance. You don't have the same liquidity shock in the system that will force a deflationary or an unwind. But when you still can have a default cycle, but what that means, instead of getting a 10% return, you might get a 5% return, and you might not get re-upped with regards to your clients. So there's a vintage risks associated to that, as opposed to economic shock risk.
Peter, European systemic risk. I mean, I know there's comments from the Bank of England from time to time.
I think everybody's pretty much covered it. I mean, the issue, obviously, in Europe is everybody speaks funnily. Languages are different, but more seriously, what's very important is every credit protection in every jurisdiction is a little bit different. In some places, it's massively different. And so you couldn't have, I'll be controversial now, but you couldn't have a bunch of New York bankers with tassels on their shoes fly into Paris and do leverage finance. My co-head, Mathieu Vigier, knows every mandataire, that's the insolvency people, in Paris, and you need to have that personal relationship to work out if something's going to go in Safeguard, what's the protection, how do you get out. It's different in Germany, it's different in Spain. Italy is a law unto itself. UK and Netherlands, pretty much the same. But you need to have that understanding about localness, otherwise you could get into, I'm not saying it would be a systemic issue, but you could certainly get yourself into trouble as an investor anywhere in the cap stack by not understanding the insolvency rules in the jurisdiction in which you're operating.
We call it Florida here.
So just a couple, two more quick topics. We're going to go to Q&A, but I want to talk about the outlook for regulation in the States. Right, I think there's some misunderstandings out there about how opaque private credit is. There's actually a ton of information available if you really look for it. So Colbert, to you, how do you think regulation changes over the coming 18 months in the U.S.?
What about somebody else? I feel like I've started every one of these. Do you want to?
So I start?
Yeah, go ahead, start.
okay.
Yeah, go start. I think that's fair.
Yeah, I've got the worst carbon footprint in the room, so I should get to speak. So we're not seeing, and I think you were surprised by this, we're not seeing a lot of regulation on the horizon in a European context. And it's back to the point I made earlier that loans have been made for hundreds and hundreds of years. the direct lenders, as with most of private credit, don't really run that much leverage. We're matched, we're taking risk out of the system. I think where we'll see some action is, let's see where the retailization or the democratizing of alternatives, where that comes out. And it's still relatively early days. We're looking at it, of course, others are ahead of us in taking money from high net worths and then investing it. Let's just see how if the promises come true. I always worry about fees on fees. I worry about quarterly liquidity. I'm worried about typically get that money from high net worths through a wealth channel in one big lump sum. Well, what do you do with it when it arrives on Tuesday and there are no deals for the next 2 months? Do you put it into syndicated loan or high yield bond market? And what if that market is crapped out when you actually have to liquidate some of that to do your direct lending deal? And so we'll see how that plays out. And that, from our perspective, again in the European context, where the FCA or the Bank of England are spending most of their time is in and around that protection of the consumer. They're not particularly worried at all from what I see around direct lenders themselves. I'd really like them to see them have a go at K&E and Simpson Thatcher, but that's one for Christmas time.
And for those in the room, those are legal firms that help companies figure out ways to move assets that may be unanticipated by lenders. And Jimmy, I'm being polite.
Yeah, I mean, I think some of the regulation is already out there. We've talked a lot about it with regards to what that means from de-risking, de-leveraging the banks, and that obviously is the growing opportunity set. I think regulators, and I agree from a policy perspective, but I say are very, very engaged, right? They are trying to learn and understand the ecosystem. It varies by country. They're trying to understand what it means for their investor universe, what it means for different funds. There's been a lot of innovation, semi-liquid strategies in the 40 Act based on traded vehicles, LTAFs, LTIFs, all things that are evolving when it comes down to providing these strategies to a broader sense of the ecosystem. So I think the regulators are spending a lot of time with all of us trying to kind of understand it. I don't think there's like a big rush from a policy perspective. But there'll be more oversight coming associated with that. I think the biggest policy thing, which probably gets augmented to some degree, but it's not changing the direction, is the Basel III and the forced deleveraging of the bank.
Yeah, and that's where I was going to go. I like to call it Basel Endgame because it sounds like a Marvel movie. But if you look at Basel Endgame and you sit there and you say it's proposed to be here, we're here. It will end up somewhere in the middle. It won't end up where it's proposed because it would destroy banks with regards to regulatory capital. But what's worth talking about, from the standpoint of Europe and others is, if you think of Canada and Australia, they're over here, Europe's over here, we're over here. We're way far behind on what Basel Endgame is going to look like. Canada and Australia are looking forward to it. I was just over there 2 weeks ago with our team. They want it to happen because they're already there. And Europe's almost already there, and it probably is pretty close to where it will end up. So that's the biggest thing that's going to have a ripple effect through the markets is when that does get put in place. Because if you're a bank right now, we talked earlier about SRTs, which are capital relief or significant risk. That was just happening in the in Europe and Canada. It wasn't a US thing. The regulations opened up. They started allowing them in the third and the fourth quarter. We were involved in a couple of the largest ones within alternative credit. That's a space that they're solving for two things. One, Basel Endgame. I know it's coming, I gotta be able to pull up, I gotta get better RWA or risk-weighted asset. And two, I have a whole bunch of commercial real estate losses that are going to get crystallized over time. And so both of those are bad in that you're basically just destroying net interest income. Your liability costs are going up, you're taking more losses, and you're gonna need more regulatory capital. So the reason the US opened it up is they had to open it up, because unfortunately for US banks, they have the same future as European banks did for the last 15 years, which is best case scenario is flat. Because you're getting, you've had 150 basis points of increase on your liability cost in 3 quarters, and your assets haven't gone up. So talk about ARB, the ARB's kind of broken from that standpoint. And so you're gonna see a lot of changes. I don't think they'll end up anywhere near Basel Endgame. because of that, because they're going to have to back off because it will break so many banks in so many ways. But it's a very delicate balancing act between the losses plus Basel Endgame in that future.
Colbert, last point?
No, we're
Okay,
good.
let's switch gears. Last topic, and that is giving back to the communities that we invest in and work with. I mean, yes, making loans help generates jobs for many companies, but what are some of the ways that as individuals and firms that we kind of give back to the areas that we invest in? Colbert, why don't we start with you and kind of work down the way?
Sure.
Apologies, is that better? So the
Yep.
question was, how do we give back to the communities that we invest in? And so I wanted to hear about some of the different ways that we give back as individuals and as companies.
Well, I'll say, I'm sure everybody on this panel, both personally and institutionally, is philanthropic in their own ways that can often be quite personal. I'll flag something that HPS as an institution feels quite strongly about. We created at Howard University the HPS Financial Center of Excellence. We took a view that hiring a kid or two from a historically black college a couple times a year, good, helpful, but if you do it right, having a real presence on campus to really be part of training, the next generation of business leaders out of an organization like that. Not only, there's a real virtuous cycle in that, where we think we are actually going to then end up with, the candidates who come on and joined us as full-time or are better prepared. And I think there's a real ripple effect from that in terms of the caliber of those folks, period. It's a great group of students. I've gone down and spoken on that campus, and it's something we're really excited about. It's something that we're bringing in other institutions as part of this, which we can talk about when the panel's over here, grab our colleagues here. But something that we're really excited about the future on.
Yeah, look, this is near and dear to my heart, and it's from the standpoint of, in alternative credit, I left, I was in Fortress for about 12 years, and when I left, I came back, and my first call was to Ares to run alternative credit. And my ask was alternative credit, but have a charity tie-in. Because I do believe that Wall Street has a problem with purpose. As much as we all give kind of personal, we need to tie it to what we're doing on an everyday basis. So what we did, and we're the first to have done it in our scale, is our flagship funds donate at least 10% of the promote goes to global health and global education charities. I'm a poor preacher's kid from Boise, Idaho that kind of came from nothing, so maybe it's a tithe, maybe it's not, we'll say. But it's at least 10% of promote, half of it comes from Ares, half of it comes from me. And what we tried to do is tie in everything we're doing from an investment standpoint. We now have $17 billion of funds that have that charitable tie-in. And that's all been raised in the last 4 years. If we never raise another dollar, we're on pace to give over $200 million to global health and global education charities. I have served on the board of PATH Global Health, which is one of the largest INGOs tied to vaccination programs the last 7 years. Been involved in global health and education, Khan Academy, and a few others for about the last 13 years. I would love others to do the same thing, because I look at it as, it doesn't have to be 10%, it doesn't have to be global health. It could be 1%, 2%, or whatever that cause may be. It actually inspired the broader foundation that Ares now has, which has given $76 million away from global health to various causes, including $30 million to HBCUs. And that's something that I think everybody should do, because it ties it in. I think it's been personal in the past. Wall Street's always been very generous, but it's been done on a direct basis where it's on corporates. I think directly tying in what we're doing on an everyday basis, greatest decision I ever made. I am never retiring because I get to balance the investing side with the charity tie-in. And when it really resonates with the team is when you do one single deal, not the $200 million. You do one single deal. We bought a portfolio from PacWest last year for $3.5 billion coming out of all the regional bank crisis. And when you get to tell the team that that deal is going to have $3.5 million that will go to charity that you worked on, it's pretty freaking cool. That's where it really resonates with the team more than it does the broader numbers. So hopefully it'll be something that we can get others to do.
That's awesome. Thank you. Jimmy?
That's great, Joel. Yeah, I think BlackRock is similar in trying to take a good portion of our net income that we make and try to repurpose that through a lot of the charitable organizations. We operate in almost every country around the world, so they can look differently, but maybe I'll spend 2 minutes just bragging about my colleague here in the Atlanta office, which we opened up 7 or 8 years ago now. We have close to 800 people here, and my partner Chanel Frazier has really been a kind of a leader of trying to give back in the local community here. So I would say well over half of our employees are part of our, in the Atlanta office, are part of the community service team that is donating a lot of the time. We've had over 6,000 hours that have been donated by the team here to over 500 local charity organizations. They've donated millions of dollars to that. And obviously, just in the office, outside Janelle's team is a group of 40 people that is just the community team, right? And they are working with every part of the local community, but also bringing all of our 800 employees locally to all different events, services, organizations, to embed them and be as big as part of the community, everywhere from financial literacy just to ultimately volunteering and giving back. So it's, one is money, but two is culture with regards to that, and I think more and more firms should be doing more of that to embed that as part of the asset management culture.
From an ICG perspective, like everybody, like Joel's, I think that method of doing it is very neat. So the two things that resonate most with me within our firm is when we come across an endowment that is very much a charitable endowment, we immediately, it's a fee-free, carry-free. We'll run the money for nothing. So don't get any ideas, everybody. And that makes, that can make a significant difference to that charity, and it makes you feel good about it when you're engaging with that endowment, and you're here doing it. We're doing it for free. The second thing that I've always enjoyed, for those of you who know London, the Square Mile sits next to a region or an area called Tower Hamlets, which is incredibly. I don't think there's anywhere in England or in the UK where the contrast between wealth and no wealth is as stark. And so we have a bunch of kids in once a month for 3 hours, and a bunch of us sit with them. The only thing that these kids have in common is they have all been expelled from their secondary school. And they're wild, some of them. and you ask, well, where's John from last year? Well, he got banged up because he got caught with a kilo of coke. It was always his dream to move a kilo of coke. This is the sort of kids you're dealing with. But you can see over an 8-month program, you'll get 1 or 2 out of the 15 who actually sort of start to get it, to understand that if you want to do things in the world, you need to pay attention and smile. It's stuff that's all obvious to us. So these are kids who've come from really difficult backgrounds. The school has just kicked them out because they're just impossible. I've never found any of them difficult. Nobody's pulled a knife. But it's a very real, practical way, rather than dollars. You see the people you're interacting, you build a relationship with them over typically an 8 or 9 month program.
It's fantastic. Thank you all. All right, let's go to Q&A. I know we covered a lot of ground. It's a ton of material. But let's go to Q&A and see what topics need to be covered a bit more in depth. Let's go right here. Yep.
Hi, thank you. Tom Levnick, Admiral Real Estate Advisors. Real estate's obviously a hot topic these days. There are well-known structures like short-duration bridge loans, senior stretch, mezz. What kind of creative structures are you seeing in the market today to solve today's problems?
Yeah, I think that real estate's at the epicenter. We really only participate where there's portfolios and large pieces, so single-family rental, net lease, and other areas. The problem that's interesting right now is there's actually better opportunities on the new side than there is on the old. Not just because some of the old is broken, but because they're over leveraged generally. You're sitting at 2 to 1, 3 to 1 leverage, 65 to 75%, sometimes 4 to 1. And when you look at it, the deals are still getting done, and they're still getting financed, and they're still getting financed relatively cheap, at 1 to 1, at 50%. So there's a massive gap, and the old deal was done at 75% off of valuation, off of about as tight a cap rates as we've ever seen. The new deals are getting done at 50% off of a valuation that's, I think we can all agree, is about as high as they'll probably be for the next couple of years from a cap rate basis. So I do think where it's really attractive is that structured equity, that pref, that ability to bring in that wedge capital. I think what we find is we really only play on the larger transactions where there's diverse portfolio and others. It's ironically, it's picked up quicker in Europe than it has in the US, because Europe does have recessions. Europe is dealing with a little bit more. They're ahead of the US, I would say, a year, and they will get rate cuts this year, whereas I think we're all getting the Fed talking about rate cuts to get the back end of the curve down, but they don't really want to do it. So I think it's in a very different situation. I think you're going to see a lot of new products kind of go out there. The problem is fundraising in the real estate side is very, 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 very hard. And so I think that there's going to be a gap in that capital. When you think about it, the gap is massive, because it's not just the cleanup of the older assets. Imagine you need 2 to 3 to 1 more capital than you did before because of where the leverage is. And so that opportunity set, to me, people are talking NPLs and other things, that's like 2026. That's going to take forever. We are in European bank mode. It's going to be a kicking in the can and other things. So I think the greatest thing you can do in real estate is be very patient, and make sure that you are waiting for the ultimate fat pitch, because anything you're doing early right now, you might regret. And so it's just pacing yourself with regards to the opportunity set.
All right, next topic. Yes, over here.
Hi, Taylor Meyer, Goldman Sachs. I've had the pleasure of allocating for my private clients and institutions to some of your funds, so thank you for being here. A lot smarter from listening to you today. My question's on the secondaries market within private credit. Obviously, grew pretty significantly in private equity over the last 10 years. Just curious, color on secondaries, who are the biggest players, where you see that secondary market going, just how significant private secondaries.
And just to clarify, is that an LP selling their stake or secondary trading of private?
Depends on how you define it.
Okay.
But yes, in that direction.
Jimmy?
Yeah, go ahead.
So I would say the path that private equity was on over the course of the last 10 years is the shape of what we will see in private credit. The more vintages, more managers, more strategies, ultimately, and greater allocations are going to force the hand where people are going to want to provide some relative liquidity associated to that to balance their book, right? So if you think about that 10 years, the typical, I would call it primary to secondary private equity might have been 80-20. That's probably more like 70-30 or 60-40, where a pension is building that private equity book with the secondary market, not just the primary buyout allocation. I would say it's still in its infancy. I know Joel's team has done it. We're starting to build it. There have been a few boutiques that have been kind of in the market, but it has been a very, I would call it more nascent market. It had been historically more focused, similar to the return profile of private equity. So think about more distressed funds, 30% IRR type targets, which is why when you saw the UK LDI, there was like a mismatch between where capital returns were and what people are willing to sell a 2-year par portfolio at. And I think as more and more capital forms, you know, the ability to kind of create mid-teens type returns with secondary LP stakes is going to be something that is, it will kind of just get momentum associated to that. But that's, I think, a 10-year build with that shape.
Yeah, I sit on the IC across the secondaries, which includes the old landmark, which includes private equity, real estate, infrastructure, as well as credit. And the credit secondaries is very early, but I think it's the greatest thing for the private credit markets is a credit secondaries market, because as that market becomes available, it allows LP to reposition their portfolio and creates liquidity. And we've seen that in these other markets, the most mature being the private equity secondaries market, where you start to see those prices go up and get closer to NAV because there is more liquidity that goes through that space. So right now, you're starting to see a recovery on your private equity, where that was 80s, now you're starting to see high 80s, low 90s. Venture is like 40 to 60, depending on what it is. It's still, basically, it's trades by appointment. There's not really a lot established there. Infrastructure is in the mid-90s. If you look at the real estate side, it's very idiosyncratic. So it can be 70s, it can be 80s, depending on what the underlying looks like. Credit secondaries, I think the most interesting, as much as there's true traditional secondaries, as you're speaking to, on the LP interest side of things, and those, to your point, you have to really divide the line between credit op funds and direct lending funds because of the duration and just the nature of what's in those funds. I would say the credit ops have a bigger discount. Your direct lendings are 80s generally, sometimes they'll be low 90s. But the more interesting transactions getting done are the structured transactions, the CVs, the continuation vehicles, because that helps bridge the gap for parties, that helps deal with, you know, people who want to transition out of one versus the other. There's more scale and more size. You're seeing more activity in credit secondaries on the CVs or structured than you are actually on just LP interests that are kind of trying to rotate across that market. Because a lot of the individual ones are just kind of done by existing LPs. It's only when you have a large pool where you're seeing enough bulk for that to kind of occur.
Can I just drop something in a European context? LPs selling, yes, we're seeing that, where a change of CIO and he or she decides direct lending is the worst thing ever and they want to get out. What I don't think you'll see anytime soon in a European context is a GP selling the last 5 assets in an old vintage. In a European waterfall, and this has been massively selfish in and around the promote as an individual and as an institution, European versus US waterfall, in credit, all of the profit, every single penny is in the last 1 or 2 deals. And so if you then flush those out at 75 or 80, then all the work, the 7 years before that, you're wasting it. And we don't, obviously, in a credit fund have there was a 3x deal yesterday that saves the day. I mean, these are all 1.2, 1.3, 1.4 times deals. We don't have in credit land that
Direct lending.
direct lending. Direct lending. At par direct lending, we don't have that thing to fall back on where Joe bought a bunch of stuff at 25 and sells it at 75. That just doesn't exist in my world. So I think you'll see, maybe not surprisingly, but individuals, guess what, looking out for themselves, and I don't think you'll see GPs selling so much. You might get LPs doing it themselves.
All right, we've got time for one more question. Let's go right here.
Nirvan Agrawal, Wingspan Investment Management. You guys have talked about deals being slightly more complicated, maybe more illiquid. How do you go about pricing that illiquidity premium versus comparable public markets?
Yeah, it's an interesting question because on some level, I'll quibble with the premise a little bit. We price a deal based on what we think the inherent risk return is in the transaction itself. We can price, complications for the business, complications for structure, you name it, we feel comfortable in that. It's not like at the end of that we say, and therefore we should put on blank % premium. Like, these are all, competitive transactions. I always smile when I'm on a panel like this. Invariably, somebody will say something about what they do being proprietary, and I roll my eyes a little bit at that. It's finance. Everything's competitive. We compete with everybody on this panel in various situations. So, every once in a while you get a one-off transaction where you can just price it incredibly aggressively, but more often than not, it's going to be what the market will bear. And that ends up being a higher price than the broadly syndicated market public equivalent would be, but that's a function, I would argue, less of a logically implied private versus public premium and more a competitive dynamic. If you've got 50 CLOs that are fighting for an allocation on a public deal, you get a price bid down just to one level, and if you've got 2 or 3 private credit lenders trying to do a big complicated transaction, because that's the number of firms globally who can do a big complicated transaction, you end up with being able to drive pricing to a more attractive place from an investor's perspective.
Joel, you want to give an intellectual historical argument about this?
The only thing I would say is to add on to, if you're looking at it at a point in time, right, and you're trying to understand all the risks that are presented there and what the kind of relative competitive deal that you're willing to put up, you're going to present that, and so ideally you'd have a risk premium associated to that relative to the public markets or your other competitor to win that deal. I think the other thing, though, what we did talk about is the covenants are important too, because let's just say you go out 12 months and everything that you had underwrote had changed, right? And next thing you know, the earnings are down. The story has changed dramatically. So you have the ability to reprice the terms of that contract at a different risk premium than you did 12 months ago. If you're in the public markets are going to do it for you, right? That loan is going to trade at 70 cents on the dollar to reprice that risk premium associated to that. And so that's the variance and controls that you have that ultimately lead into the difference in loss ratios.
I'd only add the thing we haven't talked about, and I think it's not seen on these panel, but it's true, and it's scale matters. It's way more so, in our market, you get to 200 million and above, there's like 4 people who can do the deal. You get to 500 million and above, we might be it on a lot of stuff we do. And so I think even in direct lending, you run into that same thing. People think of scale and they get scared by it. To be clear, the greatest risk and the greatest returns are on the larger deals. That is absolutely true, and I would say if you don't have scale, like we've seen, if you look at BlackRock and you talk about ETFs and other things, you don't have a reason to exist. You don't have the sourcing, you don't have the scale, you don't have that. You're left kind of go nibbling at the Chihuahua side of these little funds down here with regards to trying to do the smaller transactions, and that's a very hard place to play. And so I think that's where the cycle is still occurring in private credit, is that you're going to have a handful of large scale players, but the greatest risk and the greatest returns are without a doubt in the largest deals we do.
No offense to Chihuahua owners.
No offense to Chihuahua.
We covered a lot of ground. Thank you all very much for your time and your attention, and certainly thank you to our outstanding panel. That was awesome. Thank you very much.